Hello, everybody. It's a true honor to be here. I see many familiar faces and many that I've not yet had the opportunity to meet, and I look forward to it. As we talk through this presentation, what you'll see here is that, as Armando mentioned here, we really are driven towards the new opportunities that the alternative data space provides. And we really have pretty much leveraged everything that we have, our fortunes, our family's happiness, because of this tremendous opportunity that is there. And so as we move forward, I hope that you'll take this conversation with a skeptical eye. Think about what are the opportunities, what are the challenges, but really as we talk a little bit about ourselves here, and we'll circle back on it. The only reason that we'll talk about data capital management is really to highlight the fact that we're not a research project, we're not in universities, we actually are deploying millions of dollars around this every single day. And because of that, sometimes you have to think about what's in your selfish best interest and what really has to occur in order for you to be successful as a human, and to think about what are the trade-offs associated with every action that you do. And so when we sit here today, really, we have set ourselves up towards this economy. And what we realized, though, is that versus when I first started thinking about this in 2009, and people thought that it was a joke or a laughing matter that alternative data could add value to the investment process, we're now in a place where people are actually on the other side of that hype cycle. And we're at a concerning place in the spectrum where, yes, maybe this may take off and maybe we'll all be able to deliver that value, or maybe it'll just be another fad that people were laughing about. And so we believe strongly that it should be that former. However, we understand that there are a tremendous amount of things and challenges that stand in the way. And as such, we're really here to espouse what are in our selfish best interests. What is it that we see has to occur in order for this data economy to truly come to fruition? And then the result of that is that if anybody sitting here after going from the skeptical phase to the enlightened phase to the questioning phase sees that the things that we believe in are also aligned and congruent with their selfish best interests, I ask that you reach out to us and that we identify where are those competitive lines, where do they not exist, and try to figure out how can we work together to bring this collectively to fruition, because we are at a phase in the cycle right now where it's not really about brand differentiation and it's much more about category growth. And so as you look through my selfish best interests, I spend, and our team spends, probably 30% of our investment diligence process with any investor dealing with what was stated earlier. Yeah, this is kind of interesting, but maybe it doesn't add value. So actually the failures of other people are adding additional time to our investment process because we have to get over that systematic skew before we can actually deal into that idiosyncratic value. And as such, I actually do not want you guys to fail. Right? If you are looking at these types of data sources, I want you to be successful because there is a tremendous amount of alpha here. I think that you have to be worried about capacity in the tens of billions of dollars before you start to think about that. And I do envision a future world whereby we as managers say no to investors and that we focus in on what is the correct amount of capacity to deliver a differentiated alpha stream. And through that process, there will be a plethora of opportunities that come. And we'll speak more about that. So now that I've set the context for why we're here, let's jump in and let's talk a little bit about data capital management to put in context the things that we're going to speak about. And through that portion, we'll really focus in on what is the data economy, what are the challenges that are created, and as a result of those challenges, where do we likely see people going when it comes to investing in the future of the data economy? And then let's tie the knot up to kind of look back into history as to the Industrial Revolution for some level of guidance as to where this may go, and some of the things that we may have to focus collectively on in order to actually deliver this value. So the first thing around DCM that's important is really just the team, right? And one of my co-founders, Dr. Napoleon Hernandez, is here, and I never thought that I'd be fortunate enough to be able to bring together a team of specialists in quantitative research, fundamental investing from multi-billion-dollar funds, and then also people that have never worked a day in finance in their lives and come from the West Coast and Silicon Valley. And that's incredibly important for our investment approach because we combine the rules of fundamental investing with quantitative investing with a true ardor and desire for alternative data sources to power and add a context to the things that we're doing. And that's really all made possible because of the advances in parallel compute processing and unstructured and unsupervised machine learning. And for us, really our core competitive differentiation is driven in part by the fact that we have the ability to integrate all of these data sources together. And you can take a picture of this, but it just comes from CB Insights. Right? And the key thing that you look at from this is that right now, all of this information, and that's the reason that everybody is here, all this information that previously was only the purview of humans who were fortunate enough to have access to a privileged information silo and also had the ability to kind of tie that all together, now all of that is being made readily available to machines because of our desire to have information at our fingertips at all times. And that is really why we had to combine all of these types of talent sources to be able to bring this together. And so it makes a little bit of sense, and I was personally honored when Armando sent me an email maybe 3 weeks ago asking me to speak here. But when I thought through it, we have a rule at DCM that if you're asked to speak in front of a collection of incredibly intelligent people, you should do everything in your power to say yes. But I understood why our investors were a little bit concerned. Right? Our investors were the seed investors in Renaissance, Millennium, and a bunch of the other funds, and they said to us, hey, I never remember Jim Simons running around talking about what he was doing. He was trying to keep it to himself. Why are you speaking about it? Why should you do this? And as I thought back, and as a student of economics, I understand what they're concerned about. Right? It's a tragedy of the commons solution, tragedy of commons area, whereby if I'm up here talking about the benefits of alternative data, is that going to drive more of you to come in and take a look at it and thereby overuse, overfarm, RavenPack, and any other types of data sources, even though we're looking at all of them, and thereby commoditizing what otherwise could be alpha into beta. And we're moving into a world that, due to the transparency requirements of our investors, limited partners, pension funds, package beta will no longer get you paid. But when I look at it, and while I understand those concerns, as I've heard throughout these presentations, although I was not fortunate enough to attend in the morning, we all understand that any one of these data sources will not help. Right? If you're just trying to make simple strategies off of some RavenPack event taxonomy, good luck, you're going to lose money. Maybe it works when you don't have transaction costs, but that means it doesn't work. Right? And so both when you think about and you look back to our previous slide, around all the types of novel data and all the portions that comprises, plus the fundamentals, plus the economics, plus the price volumes, there's such a tremendous amount that the data source in itself I'm really not concerned about. And then lastly, even within purely the quantitative industry, we all know, and our other co-founder and chief risk officer says, alpha works until it doesn't. Right? And a signal may be great when that company or that market's in a mean reverting mode, but when it's in a momentum or a trend following mode, the same signal, the same truth, the same veracity can lead to great drawdowns. And so when you look at this combination and the requirement that is required to actually extract alpha out of all these alternative data sources, you get into so many transformations in such a unconstrained problem that it's going to take a while before we get to that level that we have to be fighting each other out around the brand differentiation. And again, it's really about the category awareness. And particularly when I step back and I say, listen, at the end of the day, we talked about the fact that some of the momentum, the mean reversion, the trend following has similar principles, even though it's different portions. Step back from just the quantitative industry. I started my career as a fundamental investor at TPG Capital. And regardless of any institution that I've been in, I've always been doing the same thing. Right? I've been looking to seek value, to set the timing, to adjust risk, and then to optimize the portfolio with the goal of being able to tell our investors how much capital we made at a risk-adjusted return and low volatility. And so when you think through that despite those idiosyncratic differences between the disciples of Benjamin and Graham and those of Fama and French, that we're all essentially doing the same thing, and we're not blind. We can see the tremendous amount of data that is now coming into our ecosystem that is now becoming available readily to anybody with the skill and will to go find it. I can't imagine that any responsible investor will not be focused on these three things as we move forward. Figuring out how can they get access to that data. And then once you have the data acquisition and you figured that stuff out, how are you thinking about the timing? Is it batch-based? Is it real time? Which portions of it are streaming? Which portions of it are not? Those are differentiations in the degrees of freedom that will lead to entirely different approaches to the way that you invest. After that, how are you going to think about analyzing that data? How are you bringing it up to a level that you can actually talk to it about around the other portions? And in particular, as we all know, one of the big problems with big data is that the veracity is crap. right? The signal to noise ratio is very, very low. And so what are going to be your different approaches to trying to determine what is actually true versus what is not? And then finally, once you have the ability to pull in the data, you have the ability to run some analysis on it, all of our process flows are very different in terms of how are we going to make a decision, what types of risk tolerances are we actually going after, and how do we portray to our investors why we are the best stewards of their capital. Therefore, a conversation I had with Napoleon last night, we talk a lot about the tragedy of the commons and the overuse, but in reality, it's a tragedy of the anti-commons, right? Our desire for returns and the fast way that we can prove out our return on invested capital through the public markets and our ability to make decisions as to how we deliver returns, that is going to lead all of us to try to figure out how to extract information and value out of that. However, because of our desire and our fear of beta and the historical context of our industry, we like to be very secretive. We like to act as if we're the only one going about solving a problem that we know a plethora of others are. But we hold comfort in the thought that, our team's smarter than that other person's team. Napoleon's one of the smartest people I've met. Jack's one of the smartest people I've met, as is Ali, as is Chris. But I'm sure all of you have people who went to Stanford and Michigan and have their PhDs, worked at JP Morgan. Like, we all have the same talent pool, all right? And therefore, it's really just about how committed are you? What is your will in addition to your skill to go after it? And I think that that's the only reason that we've been able to be successful where others have not, is because we created the ultimate burning bridge. We all had great positions at the places that we were. We had co-founded the big data team for one of the largest firms in the world. But we believed in this vision, and so we set a burning bridge behind us. And we said, hey, if this doesn't work, you better figure out something that does, right? And we weren't able to just say, okay, well, we have other things to go to. We had to really dive deep into this. I'm sure there are other people who are doing that. Which portions of the things that we are doing are actually adding core competitive differentiation versus are just kind of the data mungling, the janitorial work that is required for you to even play in this game? There are high enough barriers to entry to actually be able to extract alpha out of this that you don't have to go about creating new ones just because you want to. So if we go back to this, I'd really like everybody to think about this concept that Michael Heller came up with out of Harvard Law School in 1998. Where are the places where, because of our selfish best interests and our burning desire to be successful, that actually our following of the Adam Smith invisible hand is distracting and detracting value from the ecosystem? And then once you've thought about that, think about the risk-return trade-offs of whatever probability it is that you alone may be able to conquer it versus whatever the probability is that by sharing something and working together on something, you're going to actually commoditize that return and alpha stream to a level that you won't be able to deliver on your promise. So let's think back to another time when this occurred. All right, if you can sit back with me and walk through where we've been. Data capital management overview. We're serious about this stuff. What is the data economy? It's a tremendous opportunity, but is creating tremendous problems and difficulties for those who are looking to extract value out of it. Or I guess that's the challenges for the data economy. But understanding very clearly that no matter what, people are going to look to incorporate this type of information into their investment process flows. So if you understand that, where do you go with that? Well, I look back to the Industrial Revolution. I'm a big fan of it. It's probably my favorite point in history. Up until then, the United States was not guaranteed to be the world power that it is today. We didn't have any infrastructure. We had people who wanted to do stuff, but essentially people were living in small towns all over the place, huge country, very hard to bring that together. And these men, along with others, were incredibly selfish, actually, right? They were incredibly selfish. They were incredibly driven. The term robber barons pops up. The incredible slights that they did to the working class. All of these things are negative. But at the end of the day, they figured out a way that their self-interest could actually give spawn and give birth to this great country that we now live into. And so for me, if you look through this and you go around it, I may not hit on all of them, but the most important person on this page is James Pierpont Morgan. And the reason for that is because he was the one who bailed the US government out of the collapse coming out of, I forgot which one it was, but in 1878. And as a result of that, he had the ability to determine where it was that capital was going to flow. And he was not one who cared about the railroads the way that Vanderbilt did, who cared about oil the way that Rockefeller did, who cared about bridges at the beginning the way Carnegie did, but then later on steel in general. He just cared that the ecosystem and the economy grew. And therefore, anytime he saw anti-competitive behavior or he saw too much competition leading to a dispersion in the way that investing was happening, he had a very simple mechanism. He cut off funding. He chose who the winners were, and he drove standards around whatever that winner was, because for him, it had nothing to do with the return characteristics of that company, but really what new markets was that going to open up for him that he could then finance and get a great return off of. And so these are the issues, right? There's probably a lot more, and I'd love for people to add to them. But these are some of the issues that are causing this tragedy of the AntiCommons. Right? Each one of us, when we come into this and we look at these types of data sources, before we can even decide to onboard that data source, we have to think about, well, how's the industry taxonomy working? What's the level of depth and breadth of the information? Is the stuff even true? Do they do what they say they do? Because if you look at the contracts, they've come up with 1,000 different ways to say, hey, it's here, but I just put it there, don't worry about it. Right? Trust me, but you can't sue me around that. So then, if you think through that, and I want to step in around a couple of these things, how does that apply to where we are today? So I didn't, normally when we're at a pure quant conference, I wasn't sure of the audience here. I didn't want to go into too much math, but I will hit it on one thing here, which is if you look at news and the arrival of news, it very much is similar to a kind of earthquake process. Right? It's coming in clusters, right? And the arrival effect is interesting, but then there's also a leverage effect associated with how it turns to balance out after that. And therefore, as we look through it and we've seen it, we said, hey, you can probably think about this fairly similar to a Hawk's arrival process with leverage. And you can apply that and you can do that. Now, what is that applicable to? One little simple score in RavenPack, novelty. Right? Is it novel? I don't know. Maybe their score says it's novel. We've looked at our data within there. Sometimes their score is novel is true. Sometimes it's not. Maybe you can think of more advanced approaches to replicate what they're doing there. This was interesting, right? Jack was considered one of the best mathematicians at JP Morgan, so we had a lot of fun with this. But once we've got into a place where we say, yeah, our novelty score is better than RavenPack's, so what? All right? You still have to figure out what to do with that. All right? You still have to figure out what else is the context, every other thing around there. So when you look at that, normally I'd say, oh, well, do I want to share that with people? I saw today any mathematical formula that was up on a screen, everybody was writing it down, trying to think about it. Please, go ahead, come up with a better approach. All right? Come up with a better approach. But if you come up with that better approach versus what we've done and we've kept that to ourselves and we think that maybe that drives some competitive differentiation, why not give that back to Armando? All right? Because maybe this is what we were focused on along with a lot of other things, but when you take the crowd and all the things that they're focused in on, some of those do drive core competitive differentiation. I do not believe that a novelty score, a more accurate novelty score, really drives that much competitive differentiation. And so the benefits that we have of coming up with more standard approaches to that and collectively coming up with a better approach to this can then be not only applied towards RavenPack, but any of the other plethora of data sources that are coming out for which the time frequency actually matters. And when we do those types of things, and we come together and we decide what is it that we could spend a lot of money on but is not driving a real core competitive differentiation versus what are the things that are just required to play in the game, we're looking back to James Pierpont Morgan. When you look at the railroads, the best thing about the railroads was that at the beginning there were a bunch of companies that were laying this line, that line, thinking about should the optimal width be 4 feet, should it be 6 feet, etc. But the problem with that is that if one line from Philadelphia to Cleveland had a width of 6 feet and another line from Philadelphia to DC had a width of 5 feet, well, there was no way to actually take that train from Cleveland to DC seamlessly. All right, now great, that created value for whoever those railroad workers were, all right, because now they have to say there's trains that are specialized to their tracks, all right, and maybe they were able to capture some value. But the world will not stop, man. That will not last. And so that type of permanent or that temporary value will essentially be commoditized away as the world forces a way for us to interoperate, for us to get from New York City to California without having to change lines every time we switch state. All right? And out of that standardization and the standardization thereafter of the chassis that led to on the trains, we were stopped worrying about, oh, what is the steel laying down, and we started focusing in on Rockefeller's oil that was flowing through that. And because Rockefeller could flow his oil through that seamlessly at a lower cost and not have to pick up and transport, you know, an entire next industry was able to thrive, least of which the automobile industry, thinking about the derivatives out of that gas processing. So that's the same thing that we have here, right? We can look at it, and anybody who's dived into RavenPack's data, you know, hey, the taxonomy is okay. It's good. It may not be their problem, right? It may not be their fault. It's the fault of the general industry because the QSIPs, the ISINs, everything else doesn't really speak together. Well, it doesn't speak together because they don't want it to speak together, right? Because they want to drive this type of differentiation such that they can actually drive their value out of some level of brand differentiation, marketing, and the network effects around there. What technology is doing is it is breaking down those network effects. It is adding transparency such that we can identify who is the best in class, not as who is the best in marketing. All right? And once we do that and we focus in on who is the best at their specific thing, all right? I grew up across the river in Brooklyn. We had this saying, stay in your lane, right? Like, we'll do whatever it is best, all right? And once everybody focuses in on what it is that they do best, and they realize how by contributing that to society, they can actually capture that value, then we get into the place that actually enabled Ford to become the commonplace name that it is. It had nothing to do with their car, their chassis. It had to do with his innovation around the production plant and the specialization of that and then moving it forward. And through that, every American was enabled to have a car. And because of the railroad or the highway acts, we actually had paved roads for those cars to actually go down. And therefore, McDonald's was able to pop up along every single highway. An entire ecosystem came out of that. And yes, would Ford potentially have been richer had he been able to do all of that? Sure, but he would have failed in the process. And therefore, because we're in a place where this tremendous green land is waiting for us to put up steel architectures around it, we really have to think about what is going to enable this to come to the next portion of the society. And the last thing that I would focus in around that, and this is actually, I think, in the context of what I believe should occur, the biggest issue around that is permissible data use rights, right? Whereby I'm sure that Armando's getting all these different emails from all of us saying, hey, this thing sucks, that thing sucks, make this better, all right? But is he able to espouse that? Is he able to share that? Probably not, because it's our data, all right? I don't know how core competitive differentiating that is, all right? We may be looking at it, but by espousing that information, does that say what our investment strategy is? No, I don't believe that it does. Furthermore, we're in a world where data enables you to just deaggregate, aggregate, depersonalize, and the like. So you can say, hey, I found this issue without actually saying that it was attributed to you. And if we can create in a similar manner of these understandings of privacy, permissible data use rights, aggregation, disaggregation, then we can do what market was originally formed for back in 2001, which was to solve an issue amongst the large banks where they all had very interesting data and the likes. They all were doing different transactions, but they had no idea how to compare. And they didn't want to ask anybody because that would give too much competitive differentiation as to what they're doing. Look at them now. Like, how they're managing their trading costs doesn't matter. Their entire businesses have been commoditized away. All right? So in that context, they set up this enterprise to be able to share this information in some level of a safe zone. Now, market has since expanded into many other things, but that is the core of it. And that's really what we need to be able to come together to do, to figure out where are those things where there is a core competitive differentiation and therefore we want to hold that close to our chest, versus these are things that we know we just have to do, that it is only our pride and hubris that says that we're doing it the best, and therefore we should think about how we can maximize general value and grow the category pie. And when we do this, I circle back to actually having veracity. Right? Our successes, I'm sure, will inspire other people to do it. Again, if I thought that the world was going to stay in a place where everybody had to be $38 billion funds, I'd be less concerned about it. But in a place where people are going to do fine in the $1 billion to $5 billion range, I think that there's room for all of us. That is a percentage impact to our value on a long-term basis. These other things, the lack of veracity, having professors come up here and say, yeah, you can do this stuff, but it's essentially just going to look like the same as whatever, what did you say, the small cap index around that. Right? Those are the things that are going to lead to investors no longer believing in it, therefore managers not investing in it as highly, therefore VCs not funding it as highly. And so what you'll see is that a company like RavenPack that is currently very innovative will slide down and become just another Bloomberg. And even worse, smaller companies who are thinking about, hey, how can I throw drones into the air to see what's going on as opposed to satellite imaging? They'll never be able to find the funding associated with it because some investor will remember, yeah, it's nice, but it's really just good for academics. And then that really is what ties me back to Andrew Carnegie. We all remember him as the steel magnate, but at the beginning, all he was a bridge builder. And he went to steel because at the time, no bridge could actually cross the Mississippi River, therefore connecting the West Coast to the East Coast. They kept falling down anytime a train came on it. And he found steel, this structure that was actually new and would enable the next generation to flourish. But even at that time, nobody trusted it. So then he went and he found Barnum and Bailey and he got the elephants and he marched it across the bridge because during that time, people felt that no elephant was silly enough to cross an unstable structure. And after that moment, on June 14th, 1874, veracity was shown to the world. And people started to think about how can they incorporate steel into all of their process flows. And all of the buildings and edifices that we have the fortune in New York City to be surrounded by, all would not be made possible if not for that moment. And therefore, I'm here because data capital management is that Carnegie moment. That is what we set ourselves up to be. All right? We do not get to create research reports. We do not get to deliver returns that don't have transaction costs associated with it. At the end of the day, our investors ask us a very simple question. Did you make money or did you lose money? And if I have to answer that we lost money, it's a bad day for me. It's a bad week for me. You guys all know that. All right? So I'm very fortunate that we are able to say, make money, lose money, the former associated with that. All right? But it's important, again, that's our idiosyncratic capabilities. I'm more focused on the 40% of my time that is dealt with systematic impacts. Therefore, it's important that if you actually are going to run around and say that you're marketing big data, you're a big data fund, you're incorporating these things into it, do it correctly. Do it in a way that is actually going to give you a chance to add value. And even then, if you fail individually, well, at least you've contributed something. All right? So I'm here today, and I'll circle back to where I started. I'm here because we believe in a tremendous opportunity that has become arisen due to our desire to have information at our fingertips. That opportunity has enabled a tremendous plethora of information sources that were previously only the domains of humans to now be machine readable in a real-time source. However, that is only one portion of the work that is required to actually bring this data economy to fruition. True veracity is a demand for any change. Therefore, please, if there is anything that we can do, let us know. Let us know. We're not going to tell you how we come about all the strategies, how we combine things, but for things that are just core, for the data cleansing, for the validation, for enforcing permissible data use rights, for making sure that we hold Armando and others accountable that when they say something is true at this millisecond timestamp that it actually occurred. Those are things where that individual improvement are helping all of us, and therefore it is our job to understand that those externalities that are now currently not being internalized will only deliver true value if each and every one of us stands up, either decides to invest our time in this or to leave it completely alone. But that if you are driving into this, that you are committed to delivering in on your Carnegie moment. So please, thank you very much, and I look forward to seeing you all at the drinks later on.
I have some questions. So we
Sure.
have time for just a couple questions.
Sure. think he has a mic.
I think the argument which you made makes sense from an investor point of view, one who consumes data. We would want something which is very structured in a way which everybody can commonly use. But from a data vendor point of view, I think you will find less support because their core competence is, what they do. How would you convince them to, have this common structure for data and they can still compete as
It's a great question. That's why I'm not too interested in talking to vendors all the time, right? This type of stuff will not, it is in their selfish best interest to ensure that there are silos, right? It really is. Therefore, the only people who can drive this type of change are the demanding customers. And at this early stage, that is why we have to, again, come back to that time where Carnegie, Vanderbilt, JP Morgan, and a few others all understood that it was in their selfish best interest to get done what they needed to do, but that they had to come together where required to enforce some level of structure. All right, so you're spot on. I would never expect Armando, even though I think he's a very innovative and forward-looking person, to do all the things that are going to be required here. However, I would expect that when a plethora of investors comes together and says, this is what is required for us to actually extract value out of that he'll be eager and that the entire ecosystem will do it. And that's really the core of this, whereby when I used to sit at, and I understand if I was at WorldCon, Millennium, Two Sigma, something like that, I'd be quiet because I don't have to have this broader conversation. Right? I just say, hey, this is what you're going to do. Here's the capital. Go do it. When I was co-founding the JP Morgan team, that's what I did. Right? But now what I find is that when we speak to people about these types of things, they say, yeah, Michael, you're right. You're absolutely right. But you're too far advanced. Not everybody even realizes that. So it's not really a true commercial market. That's why I want to bring you guys up to speed. All right? So some of these people will start to do the things that are required for this actually to deliver the value.
One in the front.
Thanks for a visionary speech. What's in your vision that the infrastructure will look like for a successful data economy? Thank you.
First thing around that is embrace the cloud. Right? And you have to embrace the cloud not just for out-of-process batch process flows that aren't too important, but you're going to have to embrace it for the critical structures. Right? At other conferences, we talk more about our technology, and we really, you're going to have to also bring in people from the West Coast. But in the future, batch-based processing won't work. In the future, cold-based storage won't work. All right? You're going to have to be able to think about how to go. And the other thing around that is, in the future, having to upfront time your resources, not going to work. You're going to have to move into a reactive world where you can bring up resources on demand and you have the ability to integrate information. Right? That's why we spend a lot of our time, and I'm out in Silicon Valley once a quarter. Right? Because really what we do is we bring those technologies over to the East Coast. It's a lot of work to be done. I think we would have failed at it if we didn't have, that was our only opportunity to be able to be successful. But happy to chat more to anybody who's interested in figuring out ways. And maybe there's portions of what we've done that aren't corely differentiating, and we can think about exposing that in a manner to help others. The key thing around this is that I don't get paid to think about this stuff anymore. Right? I used to get paid when I was the head of strategy at JPM, Intelligent Solutions. I used to get paid for that stuff. Now, I rarely have time. That's one of the reasons I like these speeches, because they force me to think about it. All right? So one of the things that we ask for people who have large organizations, happy to tell you what it is. I just can't take the time to think about it 24/7 and to actually turn those thoughts into action. But many people do have that organizational structure where they can afford to do that.
Great. Michael, thank you very much for your speech.
Thank you.